with us Professor Lutfi Siddiqui. He's the advisor on Siddiqui is the advisor to the international affairs for the interim government of Bangladesh. We are really pleased to have him with us again. This is the second time we have the privilege of having his insights. This time I think it's going to be very relevant because I know Pakhi as one of the spokesmen for the international financial issues. I've seen him being interviewed by CNBC and some other global networks on the subject of financial crisis and all of that. So today's presentation not only covers the challenges of Bangladesh banking sector resolution, but it also takes or looks into how the other financial crisis which involved banks, the global financial crisis of 2008 and 2009 that started off from a mortgage crisis and subprime loans or something. I mean, it was a very complex affair, which ultimately, was leveled against China for having too much of trade surplus and excess savings going around the world, and which really gave these financial institutions to leverage these financial securities and get into this create the subprime crisis. So I think we have a good presentation today. Dr. Ashiq Rahman has been busy. He's been spending quite a lot of his time looking at and participating in the exchanges that Bangladesh Bank has been having with the international experts on how to resolve Bangladesh's banking sector problems, which I have described as a sort of banking sector Armageddon. What happened is unprecedented in history. You can't tell me when there was another country in history or any other banking system that was literally robbed, plundered in the way that it was done in the case of Bangladesh. When we have a $50 million bank heist, it becomes global news. But in this particular instance, it's been in the billions of dollars. And by now we know there's a lot of money laundering and all of the things that we now know pretty well. So I am not going to, I probably don't need to introduce Dr. Siddiqui. He used to be a professor in practice at London School of Economics before he came in and at the invitation of Professor Yunus, our chief advisor, and he's providing service to his original country. He's actually from Chittagong. His father used to be a member of the Bangladesh civil service. So he's connected with this country, and therefore he's got a real chance to provide some service to the country. And I think we're all privileged to have somebody like him with the kind of expertise and the background that he has had in international affairs and in teaching and research in some of the leading academic institutions of the world. So with that, I will now pass on to Dr. Ashiq Rahman. But before that, I think I also need to mention that we also have a special guest, the chief economist of Bangladesh Bank, Dr. Mohammad Akhtar Hussain, who is also a Bangladeshi Australian. So his location, though in Australia, is now providing service, like Lutfi Siddiqui and many others who have come from abroad, and they are doing a stint with the interim government. And I know that it's really the service which really brings them here. It's not the compensation, which is clearly nothing to match their earnings in the countries they live in. So we have Dr. Akhtar Hussain, the Chief Economist of Bangladesh Bank. We are also joined by Mr. Mohammad Zahir Hussain, the Executive Director of Bangladesh Bank. He's in the Bank Resolution Department, so he should be knowing a lot that's going on with respect to these bank resolutions. So we are all grateful that they have made the time. So now over to Dr. Ashik for the keynote presentation.
Thank you, sir. Morning to chief guests, distinguished guests, special guests. Without the burden of repeating what Dr. Sattar said, I think it's pretty clear to all of us that our banking sector is in a very fragile situation. It has been subjected to the kind of plundering that is unseen in this part of the world, and the fragility it has created is not going to go away if we avoid it. The fragility that we have created in our banking sector needs serious actions, and these actions have trade-offs. There's no free lunch. And the purpose, when we were discussing about that this problem is here to stay at least for 5 years if we get things right, that there needs to be a critical mass of bankers, policymakers, and academics, and people from the journalist community who understands this issue, who understands the trade-offs of all the policy options, who understands that there is no easy fix to the kind of fragility we have created for ourselves. And the purpose of this discussion, this conversation, one of my friends, Dhruv, was asking what's a trigger presentation. And that basically means that we just want to trigger a conversation about the nuances and the tough decisions that awaits us. And so that we develop an body of expertise so that we can handle this properly. There's no easy fix, there's no easy solution, but there is light at the end of the tunnel if we get things right. So saying that, I think, this is the nightmare of every presenter when the pointer refuses to obey. Sorry. Yeah, sorry, thank you. So, bank failures, what drives bank failures? We know that bank failures have two critical dimensions. One is when a bank becomes insolvent, and one is when they face a liquidity crisis. And when do they face insolvency? We know these common problems when they have a high NPL, when they have chronic under-provisioning or evergreening or restructuring of loans, when they face macro shocks like FX depreciation or weak enforcement of recovery, things like that, and that can cause insolvency problems within banks. And then there are liquidity problems that can happen when depositors lose confidence. Something that was about to happen in August 2024, which we kind of prevented. We must appreciate that. It can also happen when there's a maturity mismatch, when you're doing a lot of long-term lending with short-term deposits. A problem very chronic to Bangladesh because our capital market is not very developed. So These are the prime reasons for bank failure. And once you have bank failures or the fragilities these problems create within the banking sector, the idea is that we avoid the mistakes of the past. And in the past, we have seen that if you don't address bank failures, you create a zombie economy. You create zombie financial institution, you create credit crunch, you create a stagnant economic space, right? And that past experience of the Great Depression and all the financial crisis that has followed, especially after 2008, has given birth to the idea of the resolution framework. So what is the resolution framework? In very short, the resolution framework is about orderly management of bank failure. Orderly management of bank failure where private money cannot solve the problem anymore. The idea is to ensure critical financial services keep going on, critical economic services keep going on, and avoid or minimize taxpayer bailout as much as possible. So the idea is that you work as a shock absorber in the financial sector to ensure that the banking sector can jump back or can recover, if jumping back is a bigger word. So the idea is to protect financial stability, minimize taxpayer exposure, strengthen market discipline, kind of provide a legal kind of predictability about what is going to happen when the banks fail or banks are about to fail, kind of predictability for the depositors, predictability for the borrowers, predictability for the shareholders, and ultimately you preserve economic value as much as possible by minimizing disruption. And that creates a solid financial sector that is ready for international cooperation. Now, the modern origin of this is 2008 financial crisis, right? We were in London at that time. I remember a few years after 2008 at my school, the Queen came and said, if you guys are so smart, why couldn't you see it? And our professors were taken back. And the idea is that they were taken back because prior to 2008, the way we monitored the economy was looking at those macro indicators of inflation, growth, unemployment, balance of payment parameters, right? So we did not understand. What's that? We did not understand that these good macro indicators can hide a very fragile banking sector or financial sector, which after that created the macroprudential framework, which we'll not discuss today. It's something we'll discuss in the future. But that also brought to sight, the 2008 financial crisis brought to sight that the insolvency framework is not good enough for managing bank failures. The prior insolvency framework is not good enough for managing financial crisis. And the too big to fail moral hazard problem that existed within big banks created a systematic risk in the financial sector by motivating excessive risk-taking and that by motivating behaviors that are otherwise not sustainable, right? I think Raghuram Rajan presented a paper in an IMF conference where he presented a very powerful paper where he pointed out that, which was kind of dismissed by Alan Greenspan and others, when he pointed out, yes, financial development has happened, but at a higher risk. And that was a point that others were not, people like Greenspan were not, or Larry Summers were not willing to digest then, but that is something we digest now. So if I give you a context of what happened in 2008 and why our problem is but partially different, is the context of macro favorable condition that was there in US and UK. And there are two important conditions within which the financial crisis happened, which made it easier for countries in US and UK to fight it. The first one was inflation was anchored at a very low level, which means quantitative easing by both UK and US was possible without triggering inflation. In US, we knew that they bought $1.7 trillion of mortgage-backed securities, and policy rate plummeted to nearly zero, but it did not trigger inflation for almost a decade. So a favorable inflationary climate helped bank resolution and the recovery that followed. And also the debt to GDP ratio in US and UK. If you see US, the debt was 40% of GDP, which means the Treasury could buy preference share of the banks, which they did, to get into the recapitalize the banks, and did not face any bankruptcy. So in US, they bought the preference share. In UK, they did nationalization, and they insured the toxic asset. They did not buy the mortgage-backed securities. It was like a quasi-AMC. But in both the cases, they could do it because they had a low debt to GDP ratio, which subsequently rose. In US, it's 122% now. In UK, it's more than 100% now. After absorbing the 2008 financial crisis and the 2020 COVID crisis, all these bailouts have finally got reflected in their balance sheet now. But those were the two kind of critical measures they took on the solvency part to make their bank solvent and to ensure that the liquidity was there. Since then, a resolution framework has come into being that, we need to orderly manage bank failures. And the idea is to minimize taxpayer exposure, continuity of critical function, predictability of rules, and cross-border coordination. And if you see, through our interaction of Bank of England, this is the framework that Bank of England kind of uses, that the resolution framework regime, if I can say, is divided into 5 core bodies. The first body is about supervision regime, right? You supervise the banks properly. Then the part of it is get them to produce a recovery plan. That they must know, the banks must know what to do when the music gets tough, right? When things get tough, they must know what to do, right? How would they recapitalize? What assets they will sell? What assets, what are their hedges? How they have hedged their risks, right? That is the part of the recovery plan that they must develop to solve their problem on their own under the supervision of the central bank. Of course, if the private solution is not there, or if a private solution is harmful for the society at large, then the resolution regime kicks in. And the resolution regime kicks in, and then deposit insurance kicks in, and the last lender of the last resort dynamics kicks in. Now, all these different dimensions have preconditions that Bangladesh needs to develop, right? If you want supervisory early intervention, do we know how good quality stress testing are within banks? We have people from banks, they can tell us. Is the stress testing regime framework, is it good enough? Does Bangladesh have a good stress testing regime? Is Bangladesh Bank doing enough to monitor them effectively? Because without that regime, you cannot stop or detect early what is heading your way, right? So those are the things that we need to get right in the supervisory early intervention area. In terms of recovery planning, are these recovery plans that being submitted, are they just papers, or do they mean something? Does Bangladesh Bank have the capacity to review it properly? If not, what can be done, right? This is a new problem. Again, it's not holding anybody in the dock. It is a conversation we must have. That are these recovery plans just tick box that I have submitted a recovery plan, but nobody reviews it, or those who review it don't know what they're doing, don't have the capacity? Again, we need to figure out what's happening. Resolution regime, right? How does Bangladesh Bank have the legal authority to do it? Now we have a ordinance. We just passed an ordinance, a very fine legal document that Bangladesh Bank and the interim government passed, the Bangladesh Bank Resolution Ordinance. And of course, the ordinance gets the job half done. We now need to know how to execute this ordinance. And this conversation is part of that, taking that conversation forward. Of course, resolution would need creating a resolution fund, ensuring the deposit insurance is well funded, ensuring that the banks have the loss absorption capacity. Those are where the main instruments of the resolution regime, knowing when to wind up, wind down, and when to recapitalize. A template needed to take that conversation forward. So these are kind of the main tools through which the resolution framework gets executed. Now, in terms of the pre-crisis phase, I have discussed that the job is to ensure that we supervise, and we know that banks have a recovery plan. But if we see a crisis happening, what we do? The idea is here to ensure the banks know how to navigate their own storm. And Bangladesh Bank making sure that their know-how or their plan is a rigorous plan. How do they recapitalize? Of course, if public-private money is no longer good for public interest and a resolution is needed, then decision needs to be made on what kind of bail-in process you trigger, what kind of asset separation you trigger, what kind of resolution fund you have mobilized, what kind of deposit insurance template you execute, and of course, who gets compensated first, right? That is kind of the framework that needs more discussion. And once that process is over, the idea is to restructure, recapitalize, and resend the banks. Those you have resolved to the private sector. Now,
Keeping the time, so you have 10 more minutes, so please.
as you can answer. So if you look at the timeline, this is the kind of life cycle Bank of England kind of produces. You see, the idea is to minimize the shock, right? You kick in the recovery plan, you kick in the supervision regime, you kick in the resolution regime to make sure that the steep fall takes, a turn and process goes towards a gradual recovery. Now, one of the big questions that's a part of the resolution regime is how do we manage non-performing loans, right? We have a 6.4 trillion Dhaka non-performing loan, 35% of our deposits. Now that problem is not going away, right? And globally, there are a couple of strategies to handle that. One is, if a bank's NPL is too big, you liquidate. There's no other solution to that problem. You go for liquidation and you protect the depositors through deposit insurance. When you don't know whether a bank is good or bad, worth saving or not worth saving, impose AQR. And I think Bangladesh Bank needs to be congratulated in terms of doing this thing as transparently as possible and not hiding the problem under a carpet or curtain, right? Some people say, oh, the NPL has risen. No, NPL has not risen. It has been brought to surface. It was hidden. The accounting magicians were hiding it. Now we have brought it to surface. So let's not say NPL has risen. It has been brought to surface. So let's get that story right. And once you have an understanding, you decide whether to liquidate, whether to resolve. And this is where the valuation of NPL comes in, a very important discussion, because you have to park a sum of your NPL to an asset management company. Now, traditional discussion is, how do you value it, right? Now, if you have the Chinese experience, they created 4 AMCs. They valued the NPL at book value, and AMCs issued bonds that were guaranteed by the Ministry of Finance of China. and the NPLs were transferred to the four AMCs. Now it's a fiscally costly move, but it is one of the options out there. It's a very costly move because you're valuing at book value. And then you have the Malaysian experience where you valued it at market value. Ministry of Finance invested in that process. You valued it at collateral, and then you transfer, and that process plays out in their level. So you have to, Bangladesh Bank and our banking community has to decide now, how do you decide on legacy NPL, and how do you decide on fraudulent NPL? For fraudulent NPL, restructuring won't help. For fraudulent NPL, you cannot value it at market price because these are backed by zero collateral or paper collateral. There's no collateral there. So there's no way to park it on AMC at a market value. So what kind of discount price do you agree on? Right? You agree on a discount price that protects the solvency and liquidity of the banks? A conversation that Bangladesh Bank needs to have. We are not providing a solution here. In terms of legacy NPL, the theory is right. So this is the conversation. In terms of Bangladesh, I think if we run to the policy, we know what are the steps that Bangladesh Bank has done. I think the way forward that I want to go to is if we have a 6.4 trillion Taka NPL, if we park 10%, 25% to an asset management company, that increases our contingent liability to 14%. If we park 50%, that increases our contingent liability to 17%. And if we park 100%, that increases the contingent liability of the government to 24%. These are policy costs. There's no free lunch. And this is something we have to decide on. So in terms of the key policy recommendation that needs to be thought of is that we need to do time-bound AMC. We need to separate fraudulent NPL from legacy NPL and figure out a framework to handle both. We need to expand our resolution, create a resolution fund, and expand our deposit insurance fund. We need to create kind of a collateral enforcement insolvency framework. And we also need to introduce kind of a loss absorption buffer within banks, which is called PLAC, loss absorption capacity in the West. Of course, the fiscal problem, the financial sector problem cannot be solved. Sorry, the pointer is not working. Only through this. On the fiscal front, we need help from the fiscal front. An exceptional time, problems sometimes needs exceptional solutions. So now I think it's for the next elected government to increase the tax to GDP ratio. They need to figure out ways to expand the tax framework, maybe privatize a lot of SOEs, figure out where to get that money from, and rethink the subsidy framework, without which the fiscal space won't be created. Now, all these options are very costly. But if you don't do it, and if you don't accept the trade-offs, what you'll be stuck with 6.4 trillion Taka NPL on your balance sheet, is that you'll have a high interest rate economy, and the banks will keep asking the central bank to print money, which means you'll have a high inflation economy, which means you'll also have a low investment economy, and you'll have a low growth economy. You'll be stuck in these four bad quadrants: high inflation, high interest rate, low investment, low growth. That is the cost of ignoring the problem. I hope we will not ignore the problem. Thank you.
Thank you. I think that was a lot of substance, a lot of food for thought, really. And you've done a marvelous job putting so many issues and ideas together. All I can say is that if you don't take lessons from history, you're bound to repeat it. So I guess we have to take lessons from what happened in the global financial crisis of 2008 and 2009 and what happened in the East Asian crisis. The only concern that I have is, and might have been helpful, the context. Is the context the same? Or how different is the context in Bangladesh today, particularly pre-crisis? You have this issue of pre-crisis status and what is the pre-crisis context in Bangladesh? What was the pre-crisis context in the United States where the trigger took place? And then, of course, the East Asian crisis. Most recent is, of course, the US crisis. And we're still blaming China for running huge trade surpluses and flooding the world market with these excess savings, which then the different, central banks and private commercial banks were moving around and having lots of derivatives and whatnot. Okay, so thank you very much once again for bringing this whole thing onto the table and finishing it in time. May I now request our so there's a new technique here. We need to open the floor for discussion. So we need to have a vibrant exchange of ideas today. That's the whole idea. So I'm opening the floor for discussion, and I'm passing the baton to Dr. Khurshid Alam, our Executive Director, to moderate this Q&A session. Dr. Khurshid.
Okay, thank you. We'll start the open floor discussion. Just a few points I want to make, because I'm making this because I had been sitting in a board of a private bank for 6 years. I've seen, and it's one of those banks that really turned things around and went and which doesn't face this problem. So, but it was facing at that point of time. We got it through. Issue that comes up, and also I go back to my World Bank days when I was part of the private and financial sector. When after the 2008 meltdown, at that point, everybody was talking about getting this banking sector better regulated. And so we see stress testing and all of prudential regulations in the central bank. We've been working through, and the central bank had done that. So the banks were required to do stress testing. And I used to see in that bank where I was, the stress testing, because I used to take it very seriously. The issue is the stress testing is as good as the data that goes into the stress test. So there is a problem over here. And then the other point comes up, it is Bangladesh Bank which has instituted the stress testing. Then the big thing is, why weren't the supervision being able to pick up the problems? And the problem was in the existing problem in the banking sector just didn't happen over a day. It was there. There were murmurs. Yeah, people are not talking openly, but the murmurs were very much there. Things were not going right. Now and then, Bangladesh Bank was relaxing its prudential regulations, allowing loans to be reissued, and it was making it easy. So all this was here, and it didn't work. It needs to be seen. These things were there. Why didn't it work? And if we want to make it work, then what do we need to work? The other big thing that I want to, as I put it there, at the end of it is public money. Whatever resolution we do is taxpayer ultimately. If we don't do the resolution right, ultimately the burden goes back to the taxpayer for people, for crimes perpetrated by others. And because of inadequate supervision, they didn't work. So let's hear the discussion and let's hear everybody how things evolve. So please raise your hand, and then we'll pass the mic and introduce yourself, and we'll move from there. Okay.
Thank you, Dr. Ashish. My idea is that impression is that Bangladesh Bank, the government policy is not the liquidation of the bank. They always try to rescue. If we look into the history of the Eastern Bank, Bangladesh Commerce Bank, or NCC, National Credit and Commerce Bank. So, and another point is the banking asset management company. Bank, I think Bangladesh not yet promulgated the audience. So that is another option. Also, Dr. Ashish also referred to that. So we need a banking resolution, asset management company, of course, and also the decision or policy of the government is not to liquidate any of the bank. So I want to hear from the expert on these two issues.
Assalamualaikum everyone, I'm 𝐏𝐨𝐥𝐢𝐜𝐲 𝐑𝐞𝐬. I'm representing Prime Bank today. I don't want to be overcritical of our honorable regulators, but one of our colleagues has allegedly lost his job because of that. But certain things that I cannot resist to mention. I'll try to be as brief as possible. Dr. Ashik, it was a wonderful presentation, but a few key points which are contingent to this issue needs to be addressed. Number one is our over-reliance on the debt market. So when do we start talking about the reform of the capital market? This has been a pattern over the last 15 years because there was a systematic failure. There was no escape, and everything in terms of raising capital was limited to an over-reliance on the debt market. So we need to equally think about the equity market and how that can be vibrant. All of the measures that you have mentioned, they have a symbiotic relation between the debt and equity market. So we need to talk about that as well when we're talking about policy dialogue. Apart from that, I would raise a question to our honorable regulators that what about NBFIs? If we talk about banks, at the same breath, we have to talk about reform and bailout of NBFIs. Now, this may not have come to light now, but it is another bubble that is about to burst. It is within the range, and it is equally, if not more toxic at the moment. With regards to some of the points mentioned in your presentation, I'd like to address that willful defaulter. This is a terminology which is nascent to our country or maybe South Asia. By definition, it's evidence of how we had this type of culture being nurtured in Bangladesh. So we have to eradicate that. And this is something that we can all do together, because certainly our centralized credit bureau can be even made more efficient into a common reporting platform where even other assets which is not currently included in it, it should be. I am a little bit with the extreme view that willful defaulters need to be called out and advertised, and they should not be allowed to, once being termed as a defaulter, come back into the economy and relend or get access to relending. So that is happening even now as we speak, sir. So this is something we need to think about. With regards to how to curb this problem that we're facing, that most of the banks are under-provided for in terms of provisioning, we have to address this issue that we need to recapitalize. Banks, they started, the first, second generation banks, they started with a very small capital. And these people are still calling themselves owner of the banks. This money that they are being deployed in the market is from the depositors, which is public money. They're merely the custodian of this money, and they're not doing it in a proper governance standard. So I think 2% for a qualifying share in a bank's board is ludicrous. This should be changed. Instead of limiting how much a family can own, you can limit family representation to 1. I don't think anyone will have an issue with that. But let's address the elephant in the room. Asylum only had maybe 2% in each of the banks they invaded. They didn't put any capital in them. So it's not a question about how much one single person can own within a bank. In fact, there are much more able sirs in this panel today, professors in their respective fields. They know that some of the largest banking institutions or financial institutions are owned by one family. So I think when we're talking about reform, we are going on about it in a regressive manner. And there is a clear conflict, especially in the banking district right next to me. Bankers have 2 associations, which shouldn't be. We have one association being, represented by the bank employees or the bank management, and then we have another one by the bank's so-called sponsors. And I can tell you by attending few of them, the bank sponsors, which is called BAB, they are not pro-reform, because 90% of the banks are in trouble. So what they try to do whenever this type of dialogue happens is they try to reduce or somehow they try to create a breathing space and not address the problem at all. So I think this is another area that we would look at policy dialogues such as yourself to bring this to the light of the policymakers. With this, I had a few more points, but I'll keep it short. Thank you very much for giving me the opportunity to speak today. Thank you.
Sam Sadek, and I work for the UK's Foreign Commonwealth and Development Office. So I had the opportunity to work on the policy response of the UK government to the global financial crisis, the aftermath of the global financial crisis. So I want to just bring one insight from that experience, which is that this problem of overhang of bad debt and insolvent banks is particularly pernicious because neither the government nor the banking sector actually has any incentive to solve the problem in the short term, right? And the reason is that it requires taking short-term pain for long-term gain. So no finance minister wants to solve the problem because it involves short-term pain, and they want to leave it to a future finance minister to solve the problem. And similarly, no bank CEO wants to solve the problem by recognizing that their bank is insolvent because it leads to an immediate failure of the bank. So there is a combination of this incentive plus a natural human tendency for optimism bias that, okay, if we wait and wait and keep on waiting, the economy will improve and the banks will become solvent again. So these two kind of issues mean that, around the world, and this is not, we've seen this, whether in Europe, in Asia, that governments and banks just keep on waiting and they, Dr. Ashik made this point, evergreening. So they keep on evergreening. In Bangladesh, it's called rescheduling. So you just reschedule the loans and wait for things to pick up. And this is a particular problem. And the problem is the best example of the manifestation of this problem is in Asia, it's in Japan, where in Japan we've seen what they call a zombie economy, where because they've been waiting for so long, you have firms that are insolvent and you have banks that are insolvent, and you've had 20, 30 years of very, very low growth, right? So, we can see that example. Japan is obviously a rich economy, but they've had no growth for the last 3 decades. And this is something maybe the Japanese can afford, but a country of the, an economy like Bangladesh cannot afford 2-3 decades of very low growth. Just another point is to say that, as I said, that the governments and banks do not have the incentive, but this is where an independent central bank is particularly important because, independent central banks are not their incentives are not according to a political cycle. So then they can take a longer term view and, in a technically, they should have the authority to solve the problem. But to add, in Bangladesh, the experience and the expertise of working on these kind of problems isn't there in sufficient quantity. So it is particularly important that Bangladesh is open and the central bank and the government is open to bringing in international experts who have worked on these issues to collaborate with them in solving the problem. Right.
My name is Ahmed Rashid Joy. I'm representing BRAC Bank. I'm the CR of BRAC Bank. Recently, I had the opportunity to work on the bank resolution ordinance and review the stressed assets management ordinance, the demo. So on that background, I will mention few points. Is that Dr. Ashik, thank you so much for your presentation. As you rightly mentioned, the resolution ordinance was passed, and that's half of the job done. Now, the execution of the resolution is important. For that matter, we require templates on the executions. So I will just highlight on the 2 reconstruction scheme that we know. One was the PCCID construction scheme, and second one was the Oriental Bank reconstruction scheme. Now, the BCCI reconstruction scheme turned out to be successful, and we see the Eastern Bank as a successful bank. On the other hand, the Oriental Bank reconstruction scheme is not successful. The reason behind is that the BCCI, at least on the Bangladesh chapter, was not robbed. So they had some recoverable assets. They figured it out. Say, for example, 60% is recoverable. So depositors should take haircut of 40%, and the remaining will be from the shares from the government as well as from the depositors, the debt equity swap, the classic debt equity swap. But the other one, the Oriental Bank, did not work out. Why is that? Because they did not have much on the recoverable assets. Now, what we have now is see how much is the recoverable assets on these problems we have. The government has done a fantastic thing on doing the AQR by a global firm or from outside the country, which is credible mostly, and we rely on them. Now, if we analyze those things, I think the recoverable assets, the portion of that is much lower, that the reconstructions or the bank resolution will work successfully. And that will impact the haircut of the depositors. We do not have much fiscal strength to lower that haircut from the government side. That's the important point. So the specific template should be the reconstruction scheme, at least for the 5 banks that's being merged. So how much the haircut will get, the depositors will get, and how much they will be paid through the shares of these banks. So that is important because they are, including my relatives, they're all waiting. I will only get 200,000. What about rest? And they pay literally. Let's hope for the best. So a complete scheme will show them the path that what's the future they have. On the second thing, the AMC model, you rightly said, the fake loans, we cannot do valuation of the fake loans. And again, I will urge the central bank to analyze what is the actual percentage of fake loans and some loans which are bad due to the business reasons, which can be valued, which have collaterals. I mean, the loans 284 taka given to a chocolate wala, cannot be taken for when that's not a business case. And there are thousands of loans like this. So that is important. Otherwise, that AMC function is not going to work. It's a business case. AMC has to buy the loans at lower price, sell at a higher price, and make a margin. The last point I would say is that recently governors will say we have 35.75% declared NPL. This sector doesn't need any stress testing model. It's already under stressed. And is these numbers for 100% okay, 35.75? Or there are more under the carpets? There are reassuring. I know PRI recently did a seminar and they said 900,000 crore taka. The total stress loan, the weak loan ratio is much higher than 35.75. So, as governors have said, it will take 5 to 10 years since we don't have that fiscal strength much. Thank you.
Thank you. Mohit Rahman, my background is I've just 1 month old in a private sector bank, 30 years in a foreign bank, last 20 years in Standard Chartered. So probably just looking at how private banks are operating. So I took a challenge, but let me just, thanks Dr. Ashik, great presentation. I think I'll quickly mention a few things. One thing you have rightly said that NPL hasn't risen. I think we need to correct our statement. NPL hasn't risen. Actually, it was there. It has been surfaced because I'm coming from a global bank. How do we present ourselves internationally is very important because otherwise, yeah, exactly. That's what he said. Because it's very important how everybody, we should say that it has been now surfaced and we have some action plan. I think central bank has done significant amount of work in AQR and a lot of other things have been happening. And there are NPL, legacy NPL and a fraudulent NPL. I think we all know. So legacy NPL, I'm sure, like the state-owned banks, NPLs were there for ages. So it has not come up like yesterday. The other thing is, while we talk about this 35% NPL, it's an interesting way of looking at it. It's mostly domestic. If you see Bangladesh NPL, like 35%, we don't have much of international exposure outside. If and on a percentage of GDP, I think it's much lower. And if you see our foreign currency debt is to a comparable country is more at a very reasonable state. Vietnam and other countries, if you see the foreign currency debt. So as Governor Sir has mentioned that 5 to 10 years, probably 3 to 5 years we'll be able to handle. Well, there could be inflationary pressure. But one thing we should think that 35% NPL, but we should now more focus on the 65%, so that we don't end up another 5 to 10% again from that 65%. So probably there already risk-based supervision has been introduced by central bank. I think the earlier warning system, credit rating, a lot of things needs to be addressed. We all are probably concentrating more on this 35%, but we need to at the same time parallelly focus on the 65%, I guess. And one thing Mr. Tanzil Chaudhary mentioned that the large corporates, like if the turnover or the overall exposure crosses a certain limit, they will have to go to the capital market. They cannot do everything to the debt market, because that is a big issue, because the overall whatever has turned today, because all these large corporates, they were going to banks. Banks are probably the easiest to get access to fund, but I think that should not be happening. Thanks.
My name is Mohammad Shahnawaz. I'm representing World Bank and I'm financial sector specialist for World Bank. So thank you, Dr. Ashik, for your excellent presentation. So a couple of things I want to mention first, like World Bank Group has strongly supported central bank on designing the asset quality review and also bank resolution ordinance, new NPL definition, deposit protection ordinance. That is support from the strong World Bank collaboration and technical assistance. Apart from that, we are closely working on having a distressed asset management act for the country for the NPL resolution, and also the insolvency act, so that the bankers colleague can recover the money quickly from the defaulted borrower, and also the money loan code amendment. So that's from our ongoing technical assistance. But from the presentation, what we have heard and what we are seeing from the industry, that there is a tendency that is good perhaps to save all depositors, all banks, but the question remains, how much capacity do we have? What fiscal space we have? And whether we are earning enough revenue to pay off that debt. We are talking quite a lot that our debt to GDP is not that much, moderate. But are we earning enough to pay off that debt? That's a question. We have to have answer for this. BRO has all these options: merger, amalgamation, bridge bank, but there is also option for liquidation. A bank that is non-viable, non-sustainable, and we are not seeing any hope with 90% of NPL, what is the point of saving that bank? So this question policymakers need to answer, and also think really rigorously for the concept of macro fiscal sustainability, because there is a risk that is called sovereign bank nexus loop. We might not push our country in a situation that state borrowings heavily from the banking sector and banks, and that is bank overburdened with the state. And if any yield rise will further shock to the banking sector, or further banking crisis would lead to the state shock. So that must be taken into consideration so carefully. And the third point is that so that's also our point is that also that if we see that NPL that is 36% we are talking about, that 50% lies with the state-owned banks. So the question is, do we need these so many state-owned banks with this mandate while commercial banks are actually performing the same mandate? So that question also need to be answered. What should be the mandate of state-owned banks? What should be the governance mechanism for the state-owned banks? And whether the capitalization of the taxpayers' money that should delve into the state-owned banks should be just a free money, or there should be an accountability framework and governance should be there. Thank you for my sake.
Nafal Wahid, UK Government FCDO. So I just wanted to focus on one particular point in relation to the central bank, which is, so from time to time we've heard from the central bank in terms of how they're thinking about a whole set of issues, whether it's the smaller Islamic banks, merging them together into one larger bank, whether it's, we've heard the governor talk about foreign investment into Islamic bank, the actual Islamic bank. I think what's important is for the central bank to actually come out with very clear communication strategy and a communication sort of guideline in terms of how it sees the overall bank resolution strategy. It's important in the sense that it would provide more confidence to the market, right? So there's obviously, not a single solution that would solve the problem, right? There are a bunch of banks that are failing that probably need to be liquidated. There are probably a set of banks where, you could have potentially other Bangladeshi private sector banks, acquire them, right? So that's a second set of solutions. There might be a very few, probably one or two, where that might be of interest to foreign investors. So that's foreign capital coming in. So when you're looking at 3-4 different types of solutions, how does the central bank actually see what solution being deployed or used for different types of banks, right? And I think that clear communication strategy hasn't been communicated, which leads to, I suppose what the challenge it creates is, it creates confusion and it creates uncertainty in terms of how do you resolve this problem over a relatively longer period of time. I mean, I'm just thinking that in the last 5 years, the only example I can think of a Bangladeshi bank acquiring another bank is Bank Asia acquiring Bank Al-Falah, right? So that's a local Bangladeshi bank acquiring a foreign or an international bank. I think it would make a difference if the central bank were to go to some of the profitable Bangladeshi banks and put forward the question to them that, what would it take for you to be able to acquire some of the troubled banks that are not completely failed, haven't been completely defrauded? Because let's face it, why would a private sector bank buy a defrauded bank? I mean, it's not a likely option, but there are options there in terms of mergers and acquisitions. So not the entire problem is not something that the central bank has to try and solve on its own. The private sector banks can take the lead in solving some of these issues, but what it does require is for policy guidance and clear communications from the central bank. And I feel as though that's an area where better communications will probably help.
Working. I'll withhold my remarks to the end. I just wanted to respond to this particular point. It's more a question than anything. You have kind of outlined what will be the mix of policy that will ultimately go when we're modeling through a range of possibilities. There will be path dependence along the way, action, reaction, monitoring, signaling, all of those things. I would just question the value of 100% clarity on this. There is a value in strategic ambiguity when it comes to resolution of something which has a systemic impact built into it. So I'm just going to drop that in there. I'm not saying the central bank is getting it right at the moment, but this general comment about 100% clarity and communication will help, I'm not fully convinced on.
Yeah. Something that I wanted to feel, and we'll also have another banker over here. Very important question has been raised that this whole communication and then how this resolution goes through. My own question, and also representative of the BRAC Bank. Two done before, one successful, one unsuccessful. EBL was successful, and BCI is already in a trouble. We are now going to go through another big bank resolution with the merger of those 5 banks. Any views on how this, because at the end of it, there's a big chunk of it, which is 98% NPL. So there are no problem assets which you could go into. Then how do you go about doing that? And public money kicks in. Without public money at this point, until it's ready to go to a private institution investors, banks to be ready. So there's a public money at risk. How do we go about that? Any views on that? How do we ensure that the private public taxpayers' money don't get wasted? And ultimately, we come to resolve and not turn it to another state-owned bank. We don't want it to be a state-owned bank again. This is because there is danger. There is also danger in it. So some views from the floor, you go ahead, and then we'll also hear from a banker.
Thank you. I'm Subafrin. I'm representing Citibank, and thank you so much for this insightful discussion. I'll just keep it very brief. So I have just 2 points to highlight. So we are seeing that banks are currently moving towards from traditional banking to investing in safer opportunities like government securities for obvious reasons, because of the credit asset quality. They're now going towards, you would see the profitability of the banking industry has been quite stable because the banks are now going from the traditional credit growth towards the government security investments, towards the risk-free, earning the risk-free rates. So what is the view on that? Because that probably is not a sustainable approach. Maybe for the time being, that can be one of the approaches taken by the banks, but that is impacting the economy as a whole from the credit growth perspective. Secondly, we see in a lot of developed countries, there are active secondary markets for loan sell-off. So I do understand, given the kind of macro that we have, or the political stability, or the other frameworks, it might be difficult to have a proper active secondary market, but we do understand by taking guarantees from certain multilaterals, it's quite possible. And you would see a lot of good banks would then come up when they would say that other multilaterals are providing guarantees as well. So that can also be an sort of an opportunity. Just wanted to put my 2 cents on the table. Thank you.
Thank you. Thank you. Good to see Zaidi after a long time. It's good to see you. I don't know what has happened. You have been getting in for third time or fourth time within a few days. So it's nice to see you. Nice to see you all. Actually, this view about bank distribution, this troubled banks, my view is a little different. I've been hearing what he has been saying, like this banks should be allowed to fall. I don't take it. In our kind of economy, we should be trying. We should be understanding the core issue. Core issue was around governance. Core issue was loan vending at the pool. And the second core issue was the purchase. These two. Whatever has happened around these two. Vending, as a board directors acted as a vendor of loans. To stop that. And that has to be stopped by bringing good governance. And the second issue is another minor one as compared to the loan, is they were engaged into purchasing for the bank, procurement and purchase. They took over ACs, furniture, all that. So these two is all connected to good governance. Now we have failed. We have failed, and the 5 banks we're seeing, and there are as many as other 5 or maybe another 5. So these have been looted in some ways. So we cannot undo that. What can we do? There are 2 core things here. One is deposit, one is capital. So these banks actually, because if government's intention, political will is there, proper actions are taken, then people change. Their minds will change. If they come up with right kind of branding, right kind of strategy, right kind of promotion, right kind of image building, brand equity building, people will start again depositing into them. So the first problem is solved. Because it's a growing economy. Don't forget that 91 billion has now turned to 470 billion. Soon it will reach $500 billion. So we need banks, and people need banks, and banks also need people. So deposit, I believe liquidity will flow. Right now, I read in newspaper such funny thing, like there is no liquidity, blah, blah. There is 1.5 trillion Dhaka excess liquidity, excess, in the banking system. Meaning certain banks are too much trusted. And certain banks have their cash counters shut down for a time being only. 1.5 trillion BDT excess liquidity in the banking system. Another thing is 2.87 lakh crore taka. So 2.87 trillion taka is net money. That's not in the system. Look at total M1 money, reserve money, the money in circulation. 4.16 trillion. 4,16,000 crore.
তার মধ্যে 2.87 lakh crore or 2.87 trillion is under the mattress. Financial inclusion is something real. This money must come in the system. If bKash was not there, the mattress money volume would have been even bigger. So meaning entities must come who people trust. People are trusting us. We are flooded with deposit. Yesterday our list came. Have you even seen Citibank's deposit grew the highest city brand? 10,000-12,000 koti in 9 months' time. I cannot even think of this. Like it normally would have taken 3 years to get this much of a deposit. But this year, because of those that have fallen, people are coming, meaning people haven't lost faith on the banking system. People have lost faith temporarily on the salons of the world, but not on the banking system. So many banks are flooded. Yesterday, the list contained 11 banks. All of them are hovering around 5,000 crore to 12,000 crore, the highest city brand. New deposit net. So this is unbelievable how much people still trust this government, how much people still trust banking system. So get the deposit, get your other than lending, because you will be caught up in that net of not adequate capital, because you will be writing down some assets, some bad debt. So this is a temporary phase. But banks do not only earn from loan interest. Bank earns from many other things. Banks earn from fee income, commission income, LC commission. Banks earn from exchange gain. Dollar selling, bring remittance, sell it to interbank, sell it to other banks, sell it to import customers. Banks earn hugely from LC business. There are 7 big earning pillars for a bank. Not only lending. So this on the survival period, they will do all those 5-6 other activities. Some income will start coming. They will be able to pay their salaries. Then the first taka will come, which is above salary and gas, pani, vidyut and body part of the branches. Second taka will come soon because liquidity is coming, because you have built your brand right. You have again giving astha to the people. You are giving trust to the general public. People today and tomorrow, people will change. You know how much Bengalis are also forgetful, which is a blessing in this case. People will love this new brand, 5 banks together. Okay, what? Commonwealth Islamic Bank or whatever name, SIB. People, SIB, new, shiny, big logo, SIB. 5 CEOs are talking and their advertisements and all, people will start loving it. There is, at the back also, people will know, okay, there is government at my back. Government in the background. So fine, I will not lose my money. I may produce another Rashtrato bank, student bank, but I'm not losing my money. Look, Sonali, we talk about Rashtrato Bank. Sonali made last year PAT of 918 crore taka. Can you believe this? What do we talk and what is the reality? They are posting profit after tax 918 crore taka last year. So all these banks are operationally they are good. They are not good when you apply Basel rule onto them, when you apply IFRS onto them, which is if you really adjust the provision, the loan provision required, they could turn out to be bad. But in an economy like this, which is growing, even this year's growth, look at this, 4.2. This year, probably it will be 4.6 also. I have read in one of the big papers. And World Bank projection, look at it. Next year, they are projecting 6.2. And look at global IMF projection, 3.2. Entire world will be progressing next year, 3.2. Bangladesh will progress 6.4. Meaning something is happening, momentum is there. Meaning the momentum is there, start believing and being hopeful. Meaning your first problem is liquidity, that will be solved through your brand building, image building, and the notion that government is at my back. My deposit will be coming. 1. And the second thing is your capital adequacy, which will go down the drain everywhere, because you will be writing down those, 90% PNL, or for Exim Bank case, 40% PNL. So 40% of Exim Bank's 40,000 crore taka loan is 16,000 crore taka, 20,000 crore taka. I fully understand how much of that shock that is for Exim Bank's, balance sheet where capital is 6,000 crore taka. So meaning on day 1, after this return offs are done, so if it is 20,000, Exim, one of the base cases, Exim 20,000 minus 6,000, Exim will have a negative equity of 14,000. It's temporary. Earnings will come. Exim will someday come above this negative 40,001 taka. That day will be happening soon because economy's momentum is huge. So I am not a supporter of allowing the banks to fall in an economy which deals with Gorib Manush. It fall meaning Amanat Surakha Adhyadesh. Fall meaning deposit protection Adhyadesh is only you will get up to 2 lakh taka. That's not a solution. Rather, take the taxpayers' money, 22,000 crore taka or so, or 20,000 crore taka, fine, fantastic. Then their equity, their overall asset they have, I believe 35,000 crore equity. The largest bank is getting built with 35,000 crore taka equity. This is huge. This is huge. A bank needs 500 crore taka. And this bank is coming on day one with 35,000 crore taka. This is for write down. Actually, write down phase 1, then do the write down phase 2, do the write down phase 3, start building brand, two raw materials of banking. On the people side, deposit. On the institutional side, capital. Capital will happen little later. Start earning, firing the guns of all those 5, 6 other fronts of income, which doesn't need a capital adequacy. This will happen. Thank you.
Before, maybe one more person, maybe, but before that, I have a question. The company is this title that we are now. It's very nice and it's also nice to say that public money is coming in 20,000 crore. We don't want to say the Gorishan and Gorishan not do the. It's a question of the 40%. What is it? Because it's retribution and we are going to pay. And it's supposed to be the 21 product is ridiculous. Banks of the servicing is basically we are looking at the loans are always in the air. Money is deposited in the rural areas, the loans come back to Dhaka. And they mostly Dhaka into the loan. Now, also we should not take the ideal here that we have to protect the poor people. Unfortunately, it is not. That's why. But we want to go through resolution. What should be the best way of, because there is we are in this position because we were all seeing everything is hunky-dory, everything is going nice. Taking that course, I don't know. This is personally I see a problem if we just expect that automatically things are going to happen because the regulation did not work.
Sir,
did not work.
Sir, if you give me just 1 or 2 minutes, actually I have not said it is hunky-dory. Actually, I have not said there is no problem. There's a big problem. The biggest thing, good thing that has happened for our industry, and 31 years veteran, is that we all knew 9% industry NPL. We're living in a fool's paradise. Today, I know it is 35.36%, 37%. It is knowing the truth so that I can begin my journey, which is founded on the truth. I have won the battle 70%. Knowing the truth, not living there, all the banks, now we know, wow, it's 36% NPL. Now what? All the banks are doing partial write-off this month, so that it comes down. This is all globally allowed practices in USA, Germany, everywhere. We are constantly talking to central bank. We are doing this, and on that side, I didn't say that Gorib Manish Bolte is a metaphorical term. I mean the depositors interest are at stake. I mean the money has been taken or siphoned up by the looters. It's simply that there is a problem. I mean, there is a solution also. I mean, the solution is actually to merge phase 1, phase 2, phase 3. If there are 15, then 5. The solution is that simply we need 2 things. Their deposit counters are closed. People will start believing in them. That's what I said. New deposit will come. Then there are 6 other ways to do or deal with those deposits other than lending, because you will not be able to, because you don't have a capital adequacy ratio. Then someday, soon, when you are earning enough, so that on operating trading line, you are green, so that you are just green on the trading line, not net after profit line or PBT line. If you are green there for few years, you will be starting to actually building new capital. So this new capital of 6,000 crore taka gone, plus looted, say 15,000 crore, 20,000 crore taka, soon that will happen. I'll simply stop by saying this is also for Khurshid Bhai and this Mr. Zaidi Sattar, Mr. Lutfi Siddiqui and others. I take one example, please. When I joined from foreign banks, I'm the 3rd CEO of that bank when a team joined for transformation and restructuring of Citibank. It was a problem bank. It was as problematic as today exhibits. Problem bank officially, there were 2 central bank observers used to sit at Citibank board. After the full transformation, nothing but we wrote on good governance. IFC came in at the bank in 2017. American Express global brand came in 2011. Now this is country's one of the top 3 banks, probably one of the top 2 banks. These are definitely one of the top 5 banks. Now sitting beside me is another glorious bank, Prime. See the Prime's profitability. See where Prime was after Bismillah case and all, and see where Prime is. This year, Prime is entering as the 3rd bank into the 1,000 crore taka profit club, net profit club. I'm guaranteeing. We have last year have done City and Prime. This year, Prime is entering that. And that Prime was fully looted by the Bismillahs of the world. So this is just a phase. You need to go through this phase. Because why? Because there's a big economy that has taken great momentum. Alhamdulillah.
Thank you very much. Yes, please.
Very brief. Just to sort of mention that inshallah Prime Bank this year, it's not just about the profitability, but this year we will be bringing down our NPL to close to, if not below 3%, close to 3%. So apart from the profitability, that's also an important parameter. I just want to clarify, sirs, that we cannot compartmentalize public money and private money. Private money is also public money. I just wanted to mention that. Thank you.
Yeah, that's a good point. So,
Sir, Citibank's NPL 2007, 15%. Today, Citibank's NPL will end the year with 2.9.
Wonderful. So we are looking at it, everything is not lost. So the banking sector still thrives, and we have, we can be reasonably optimistic. Okay, so that ends our very vibrant, I think, but very vibrant Q&A session. We had lots of ideas put on the table and lots of exchanges. Now is the time for me to invite our special guests. And I'd like to first invite Mr. Mohammed Zahir Hussain, Executive Director, Bank Resolution Department of the Bangladesh Bank. So let's see how the situation looks from the other side of the table and how they are trying to address the problem at hand. Mr. Zahir Hussain.
Yes, chief guest and my colleagues. Actually, we are in the primitive stage. You know that we have started last year, September. And during that time, the task force, senior task force was formed. Sir is there, Dr. Siddiqui, he is also a respected member. Then we have started for 𝐿𝐴, selection of 𝐿𝐴. Then we have started a new department. It is a bank resolution department, and also in this department has been formed under the purview of the BRO, Bank Resolution Ordinance. And you know that we have Bank Company Act, but this is not enough for resolution purpose. So the new resolution has been enacted by the government. This is Bank Resolution Ordinance 2025. On the basis of resolution, we have prepared some guidelines, some regulations, and lastly, a new bank was formed, that is Commonwealth Islamic Bank. And before this, Central Bank has made some of the 5 banks. Basically, we work on 5 banks. This is, you know, that Exim Bank, First Security Bank, SIVL, Union, and Global. This is our first project. We first declared them ineffective bank, non-viable. Okay, we cannot say it's non-viable because it is ineffective, and the their financial positions are not good. They have huge negative capital, huge NPL. Some of the banks actually NPL more than 90%, and some of the bank more than 40%, and other is more than 60%. Actually, there is two options. One is resolution, and other is to make them distressed. Actually, our respected managing director of Citibank, he has advocated us very cautiously, and he told that actually he supported us that we do not go for liquidation. We are in the resolution process because if this bank will go for liquidation, there's a problem will face, the depositor will face the problem. They will get only a small money, 1 lakh now, 2 lakh. So our governor took the right decision in consultation with the government that we prepared a 10-year financial and business plan, and a new bank. I had told it earlier that a new bank has opened. This is from Nitish Naina. Actually, thanks our government to open this bank. They provide money. Now, this bank take over the 5 banks, and some of the process as per our bank regulation ordinance we are using. First, bail-in. Bail-in means if we use government money or taxpayers' money, first loss will be incurred by the shareholders and creditors. So we are following this process. Secondly, some of the depositors convert to the capital, and some of the haircut done. As you know that the proposed scheme not yet declared, so I do not say the ratio, what ratio actually haircut or elevated. So in that case, this process and the other process, the merger is not only process. There is a lot of tools are using this, and the government has taken over all the banks step by step. The board has already been formed, and this is our present progress on the. If we will success in this issue, then there are other some banks that will be also resolved in orderly, and we will use other some tool on that bank, and we consult with other stakeholders, especially Bangladesh Security and Exchange Commission, to resolve the issue. This is our the first bank case is our first issue. I told earlier that we are in the primitive stage. We have no knowledge. You know that our example is totally separate from other countries' example, because more than 90% loans are siphoned off. But in the international example, this type of example we do not get from any international bank. There are some problems, but our problem is totally separated from this. So we are primarily actually we are working in the trial and error basis. So I think today's lecture is very much fruitful for us. We will use some of the topics of the lecture to our desk work, and this is a good lesson for us. Another question actually from Prime Bank respected chairman, that is the resolution of NBFI. It is in process. Government has also provided support for this NBFI. The nine NBFIs are coming into resolution very soon. Lastly, one thing I tell that actually in terms of internal control and compliance, there is 5 system is what? System 1 is there should be a internal control in bank. There should be a risk management department of bank. There should be a internal audit of the bank, and also there should be external audit of the bank, and lastly the central bank supervision. So I think presently we do not, there is no coordination between these 5 approach, and actually I say that we should coordinate all the 5 approach to bring a good discipline in the bank. Thank you.
Thank you. Mr. Zahir Singh. May I now invite Professor Dr. Mohammed Akhtar Hussain, Chief Economist of Bangladesh Bank, to share his view of the situation in the banking sector.
Assalamualaikum. I'm Akhtar Hussain. There has been good discussion on different aspects of NPL, and it has created a serious problem for the banking sector. To me, this was not unexpected, or this is only recent phenomena, because it was continuing for a long period of time. Also, it was hidden, but it has now come to a stage where everybody is taking note of it, and it has affected the economy in a big way. Now, different aspects have been discussed. What I probably will do now is to highlight a special area, that is the impact of NPL in the conduct of monetary policy and how inflation is remain stubborn at a very high level, which is causing all kinds of problems here. The problem is that this NPL has created a serious problem in terms of raising inflation expectations. And as you know that we are conducting a monetary policy. This is not really rule-based monetary policy. We are conducting some kind of discretionary monetary policy, but we still make some announcement that we expect to bring the inflation rate down to about 4 or 5% in a year or so. But the unfortunate part of it is that there is a lack of trust or confidence in the central bank, or you can say the policymakers as a whole, that probably whether they will be able to resolve the banking sector problems and also will be able to bring inflation rate down, because they expect a high inflation in the future with obvious reasons that the banking sector is in trouble. The government needs to provide all kinds of liquidity. On the one hand, we are giving liquidity support. On the other hand, we are trying to say that we have a tight monetary policy. This conflict signal has created ambiguity, and unfortunately, that is one of the reasons why we cannot bring the inflation rate down. The second point is a little bit of a technical nature. That is, we operate in an analytical model, as you all know, economists, those who are economists, that we operate within the framework of so-called the Phillips curve. Within the Phillips curve, now the Phillips curve is not as steep as you always see in the textbook, because it has now flattened. Like what it has flattened means that you now need to create a huge dose of recession to bring the inflation rate down. But unfortunately, in order to do that, you need to raise the interest rate at a higher and higher level. but the economy is not, or the people are not really receptive to this kind of idea. Banking sector thinks that that will create serious problem, and that is also another reason why really we cannot really diminish the inflation expectation. So we rely heavily on inflation expectation, and this inflation expectation is linked to actually what is called these non-banking financial non-performing loans. That is also linked with our economic performance, and all of the what is called rating agencies also note it down. And obviously, this NPL is basically mostly serious for what is called the nationalized banks or the government banks, but the private banks are reasonably doing very well. But when they talk about their 35% NPL, they obviously see that this problem cannot be resolved because this is more or less structural. The very nationalized banks are actually creating problems over the last 50 years, and there is no, policy resolution that how it can be diminished. Another dimension is our economic growth rate is now at the rate of about, say, 4% or 3.8 or 7%. That is also causing serious problem. Now, why it happened is that most of you know that our NPL is closely linked with capital flight. So this capital flight has caused lower investment in our country. Our investment rate is roughly about 30%, and our saving rate is just 28 or something like that. And at this rate of saving, we cannot raise the capital level ratio. Those of your technical nature, you know that we have a very steady state capital ratio that is stuck there. So our growth momentum has diminished. Without raising that ratio, we cannot really raise the growth rate. That's a long-term issue, but we cannot raise the economic investment without having foreign investment. But foreign investors are not reluctant to invest because they see NPL is so high, there are not many economic reforms, inflation is high, and there is policy uncertainty, and there is also no government, long-term government or a elected government, and all these issues. So we are in a trap, really. So that's why in economic area, our idea of bringing down inflation, introduce what is called a rules-based monetary policy, keep it low at a very long time, but we cannot do that. Now that has created another type of problem, that is the perception. The perception is that the interest rate is very high naturally, the nominal interest rate is high. That is, let's say about 12% or 13%, but the inflation rate is 9%. So what is the real interest rate? The real interest rate has only become policy interest rate has only become positive over the last 1.5 years like that. Before that, the real interest rate was negative. So that means the borrowers were actually gaining by borrowing from the bank. And naturally, that was the problem. But they do not tell this. They now see that a positive real interest rate and that we cannot even raise it because we are coming under tremendous pressure. We know that how much pressure is put on the governor and all the people who are making decisions. So that's a monetary policy area. We are in a real serious problem that we cannot conduct our monetary policy independently, not only because we are not independent, but we are also under tremendous social and economic pressure from different stakeholders. Now, you have talked about the independence. Even if independent central bank, I'm not sure whether how far they will be able to go. Like, for example, if you go historically, you'll find that the very problems in the banking sector was created that you may call within the bracket is this original sin. The original sin was the nationalization of the banking sector in 1972. And that created vested interest groups. They built on their empires using money, and that was being facilitated within a kleptocratic system. And that system was almost like a deliberate attempt to exploit the resources of the state. And that is how you break that interlocking system. That is a big issue. And the government is not willing to do that because government benefits from that kind of thing. Because basically, the government has a bias in terms of what is called, we call it inflation bias. That means they want the central bank to keep control over the central bank. print money, and at the same time, they also need the banking sector to generate some funds which go to the political system. And you know that how it goes and like that. So I think we are in a big problem because we do not have actors who can act independently. We make joint decisions and also need some kind of consensus. And that consensus is highly unlikely to emerge in the near future. Everyone is talking from their own viewpoints, but as a national context, I think we need to clean up the system as quickly as we can. My colleagues and others, everybody is talking about the resolution. Yes, there is a resolution, how it will resolve the problematic banks like that. Now, obviously, the governor has taken the initiative to merge 5 global Islamic banks. Now it has created a United Islamic Bank, and it has created some kind of duopoly in the what is called the Islamic banking sector. But why we need 6, 5, or 7 what is called nationalized commercial banks under the government? Why don't we have merge all these big banks and make just one government bank if needed to do some what is called servicing to the government or bank treasury functions? We can do that. Now, obviously, if we do that, that will create a giant banking system. But if we do that, then we can trim it down, make it much more simpler, and that probably can operate. And I know that this is not a very hypothetical situation because I reside in Australia and I know their system. They also have a nationalized bank. That is the Commonwealth Bank of Australia. And that bank has a wide range of branches across the country. And they do lots of what is called treasury functions. And this bank once upon a time also worked like the Central Bank of Australia. So I think my feeling is that we need to think about in a very creative way, go out of the box and try to solve the problem bit by bit, because we cannot really solve the problem in one go because we do not have that kind of leadership, neither in the political sphere, not in the policy making sphere. So we have to be realistic, and we have to be also comfortable with the idea that we need to go slowly, probably back to positive way so that we can clean up the system. Without cleaning the system, probably Bangladesh will be in a big problem because we have all kinds of economic problems, social problems, and political problems. And we should not and cannot really use the financial sector as something for what is called taking resources from the public. So I think that my feeling is that overall we need to introduce reforms as quickly as possible and as straight way as possible, and in a way that people actually support our reform program. Hopefully, that is my main comment. Thank you very much.
Thank you very much. Thank you very much. Thank you very much. You have really turned the direction of the conversation from the internal banking sector issues to the economics of the banking sector, and points, inflation expectations. It is related to what is going on in the banking sector. So, and then the growth rate, muted growth rate that we have is also being impacted, and of course the issue of the real interest rates. And we also touched on the issue of central bank independence. So all of these are the economics of the banking sector, and so we need to. That's why we need coordination between the banking, the practitioners in the banking sector, and the policymakers and the economists who also have to relate this banking sector issues with the state of the economy. It is now my great pleasure to invite our chief guest to share his insights, his perspectives on what's really affecting this whole sort of calamitous situation. And I'm sure he's going to bring in the international context and link it with the Bangladesh with the Bangladesh phenomenon. I think there are some similarities, and of course there are also stark differences in what is at play. So, Professor, thank you. Lord Charles.
Thank you. So, Can you really hear me? I can't tell if the mic's Good afternoon and assalamu alaikum, everyone. First of all, my congratulations to the author of the report. Thank you for giving us a framework. It's really an encyclopedia covering multiple different crises and goes really into the detail of what is a systemic crisis, in those cases, internationally systemic crises, and the fact that you need multi-dimensional responses. There is no silver bullet for something like this. My recommendation would be to really do justice to that great piece of work. If we could take the recommendations that are put in there and perhaps phrase them in a storytelling manner so that we actually know exactly what we mean by each of these in the context of Bangladesh. So what would it really mean to take control of and operate a bank and then resolve it? What would it really mean to replace and remove senior directors in a bank? Again, in the context, what if the chairman of the bank is the brother-in-law of the finance minister or something like that? How would you actually deal with those? Really in the practical, everyday context of Bangladesh, I think we need to take full advantage of the freedom of speech we have right now and make these things explicit in direct local terms, not go into academic general speak. I'm also grateful for what the chief economist said just now, which is the interlinkages between what is sometimes seen as a micro-prudential issue of bank management and LPLs and its direct line of sight into inflation expectations and the cost of funds and all of those things. This has not been a victimless crime. This isn't something that is just for the professional classes. This is a criminal negligence, if not aiding and abetting at the highest level, which has cost everyone up and down the country. And I think we need to keep on reminding ourselves that the costs of these are real. If you look at the numbers, so what is it? What's the NPL ratio? 35%. And you look at some of the other crises that have been mentioned today. What was the peak NPL in India at the height of their crisis? Any suggestions? How much? Malaysia in 1997, the Asian financial crisis. You have Indonesia, Malaysia, Korea in that particular period, and we can talk about the responses to that. But what we should remember is that the immediate year after the Asian financial crisis, I was just starting my career at the time. I was at Deutsche Bank. GDP levels were contracting in double digits for multiple years, and inflation was going at triple digits. That is the level of generalized pain that was required as a necessary condition in the real economy before they could even get to grips with the banking crisis. More recently, if you look at the last 20 years or so, virtually every one of the examples that we've seen, whether it's India, whether it's Japan, whether it's UK, China, we're talking about somewhere between 5% in the UK to maybe 13, 14, 15% in China, probably 11% in India. So the quantum, the size of what we have here, in the absence of an acute crisis, this is a chronic and not really regarded as an acute crisis, 35% is an extraordinarily large number. I can't think of any situation where the country is not on practically a state of economic emergency and where there isn't a generalized wealth destruction before you can come out of a hole of that kind. Secondly, fiscal space, that has also been mentioned. What is our fiscal space? So if you look at the daily Okay, let me ask another question. What is the single largest expenditure in our budget? If you forget capital investment, the running costs, the expenditures in the budget, what is the number one item right now? Interest rates. We pay half of our budget deficit in just interest on past loans. 22% or so of the entire tax intake goes in paying interest. Roughly 330 crore taka a day, 14 crore taka an hour. We've just spent 28 crore taka just being here for the last couple of hours. And it is baffling that we don't have a sense of time, a valuation of time in the way we conduct ourselves, whether it's in the private sector or the public sector. The clock is ticking at that rate of interest that we have seen so far. And you combine that with the fact that we have a tax to GDP ratio, which is shamelessly low, and we have an FDI to GDP ratio that is practically non-existent. It is a very unique combination of scary statistics that I do not think is socialized enough in the public discourse. You would have thought less than 2 months before an election, this is all that we would be talking about, and we would be asking the political parties, what is your plan for the economy? The economics hardly ever features in our public dialogue, and I find it baffling given these mathematical constraints that we have. And these economic constraints are a constraint on all other aspirations. But the thinking still seems to be that the government is omnipotent. The government can do anything. Just go and speak to government and they'll pay for it, and forget where it comes from. It's printing of money and more indebtedness. And that is the only resolution to everything. Now, in the global financial crisis of 2008 and the aftermath of that, we've had responses from the regulatory side of things, and I'll come to those in a moment. But the biggest wholesale response was quantitative easing. The enormous printing of money. The balance sheet of the US Federal Reserve was less than $1 trillion in 2008. That went up 4 times in the decade until COVID. And in the year of COVID, it doubled again to about 8.5. So we've seen a dramatic flooding of the system with money. Interest rates was 0 for that period. Interest rates, what was the interest rate of the European Central Bank policy rate at the time? Anyone remember? Less than 0. Negative 0.25% at its peak. The Swiss National Bank was negative 0.75%. What was the policy interest rate in Japan? Negative. 10-year interest rate was fixed at 0% for an entire decade. That created an unusual amount of tailwind. And for other structural reasons, which are not directly monetary related, it did not translate into inflation. And therefore, everyone had a free run, including developing countries, including Bangladesh. And so you could buy up non-performing loans, and you could add to the stock of credit at whatever rate you wanted to without any inflation or without a runaway inflation. And I remember I used to say on my visits to Bangladesh at the time, I can give you whatever GDP growth rate you want, as long as I can create a corresponding percentage of private credit growth. And there was a correspondence between the two. Just create money and you get growth. All of that changed in 2022 in February. What happened in February 2022? Russia, Ukraine. And the Federal Reserve had, so for the first time, you then had supply side constraints. Food trade was impaired, shipping was impaired, inflation became a real thing, and the Federal Reserve had to hike rates from 0% to 5.5% in 18 months. And that is a dramatic amount of contraction in the global economy. And you could argue that that was the moment when the Bangladesh business model became kaput, no longer functional. From that moment onwards, you could no longer have your choi noi, the interest rates fixed at those crazy levels, exchange rate fixed at a crazy level, and stock market levels floored at a certain level, which basically meant it was stuck at that level as well. These three things were mutually inconsistent and completely inconsistent with what was going on with global money flows. And even though we have capital controls, our economy is not insulated from what happens in the rest of the world. So the macro environment for banking resolution in the aftermath of the global financial crisis had this tremendous tailwind of cost-free money, which we do not have the luxury of at the moment. When you have all of these, when you put these things together, it really matters who is running the country and who is running key institutions of the country. And when I go and meet with, when we were in Washington, D.C. for the World Bank IMF, for example, of the UN General Assembly, and you can imagine the lineup where you have Professor Mohammed Yunus, Dr. Saliuddin, Dr. Ahsan Mansour. That is a formidable lineup of people. Credibility and confidence, the personalities involved are hugely important. You can have the same set of policies that are ineffective if you do not have credibility in the leaders that are running it. And I think we're incredibly fortunate that we have Dr. Ahsan Mansour running the central bank at the moment. And some of the commentary I get about, monetary policy too tight, he doesn't know this, or that is just absolutely crazy. Let's get to grips with the context, and then let's appreciate what the complexity is that we're having to navigate through. At the same time, I don't want to make it into completely a negative story. I do agree with what you said. We have a tailwind. So the headwinds now are pretty strong. Global uncertainty, the IMF tracks an index of uncertainty, and that is at an all-time high right now. The previous peak was during COVID, and we had doubled the level of uncertainty than what prevailed during COVID. And we're about 5 times as uncertain as 2015. So that is the general level of uncertainty. So we have headwinds coming from the rest of the world, but we also have tailwinds. And that is the fact that demographically and in terms of the traditional definition of fundamentals, we have a trend underlying growth. No matter how badly we govern the country, we cannot escape the fact that there is a positive trend growth. But we do need to keep an eye on the real economy. That is why we're fixated on logistics, on the port, on roads and highways and energy and all of this. The real economy matters. There are limits to what Dr. Ahsan Mansour can do because there are log jams in the real economy which we need to undo because we are relying on a trend level of growth which was not available to many of the other countries. It was available to China in a big way. It was available to India in a big way. They had 7% growth, GDP growth, through which they were able to conduct their resolution, but it was never available to Japan. Japan is a shrinking economy, and therefore they had the zombie system, because without underlying growth, you cannot expect the balance sheet to repair itself. You need to tap onto the huge savings pool that the country has and do an asset write-down, a one-off asset write-down everywhere. We don't need to do that. We have a trend level of underlying growth and a trend level of deposits that should correspond to that. Now, I don't want to make it a naive thing. That is not what we're relying on. We have to do everything else. But we have to to recognize that. Now, what is it that can prevent the underlying trend growth from translating into banking sector repair? What is the theory of change? The theory of change is that the underlying economy is growing. It results in growth in retail deposits, which then results in circulation of the money through private sector corporate investment, not just buying treasury bonds from government, but actual investment, which in turn will generate returns, which in turn will create profits, which in turn will create retained earnings, which in turn will add to the equity base of banks. So over a sufficient number of years, provided you manage the tail risks, you can get to that outcome. There is a pathway to that. But the biggest risk in all of this, in that chain that I just outlined, is conversion of deposit growth into sound investments that generate profits and that add to retained earnings. And this is governance of the banks. If the chairman of the bank used to be one political crony and it's now another political crony, if the board members of the bank used to be members of one family and now it's members of another family, if you don't have basic codes of conduct and how risks are allocated, investment decisions are made, it's still done on the basis of who knows what where, then that entire theory of change crumbles and we will fail to convert the underlying growth into investments and the rest of the chain. So that is why when we talk about reforms and governance at a micro level, these are not just like to have, these are not, proportion of independent directors in the board. These are not by-the-by issues. They are core to the resolution plan. Or frankly, the plan for the economy as a whole. Even if we did not have a banking crisis, we would need to create jobs for our people. We have a demographic, people talk about a dividend, but it's going to be a demographic detonation if we don't make full use of it. And there is only a limited time window within which to do that. We have been gifted with the endowment of demography. And without a sense of urgency, we are letting that to waste as well. But governance is directly related to this. And that is why now we go back to the global financial crisis. So I was a young MD at Barclays Bank at the time, and we tried to buy Lehman Brothers that weekend, the 13th and 14th of September 2008. We failed to do that, and on the Monday, the 15th of September, we went into the bankruptcy courts and we picked up bits and pieces. But I remember that period and the aftermath of that very, very clearly. One of the threads of response after that was to really look at the conduct, governance, conduct, and incentives of those of us in banks at the time. The UK became the first country in the world to create a regulatory body that has the word conduct in its name, the FCA, the Financial Conduct Authority. And that was a realization that it is behavior and conduct which is a lever of regulation and therefore a lever of punishment. So we had the senior manager regime, which is one of the first regulations that came out. So those of us who were tagged as senior managers, the various categories, my category was a key risk taker. So you have material risk takers, key risk takers. The senior manager regimes then required us to provide our fingerprints to Interpol so that if we were to run away, they could find us anywhere in the world. The focus was very much on conduct. At the London School of Economics, I sit on the board of a center called the Systemic Risk Center, SRC. And that was created with funding from the Bank of England and the European Central Bank in the aftermath of the global crisis. And they focus on things like conduct, triggering crises, even in the absence of a major risk event. There are two ways of looking at risk. One is, what could be a major exogenous shock that could hit the system? Asteroid hitting Earth. And a lot of people spend a lot of time trying to think about what that shock could be. what the Systemic Risk Center does is they say, forget about what the shock could be. It could be a minor shock, it could be a major shock. What would be the chain reaction in the system afterwards? Will it be a self-correcting system or will it be a risk-amplifying system? And then if you have to design the system, will there be short circuits, circuit breakers along the way, or are there amplifying mechanisms along the way? And one of the circuit breakers along the way is to make sure that your regulatory institutions are independent from the political executive of government. You don't want 100% correlation in the incentives of all the parties at any given crisis moment. So if the finance minister is fixated on the next elections, as somebody mentioned earlier on, you want to make sure there's somebody else whose incentive is to do the exact opposite. And yes, it'll create some tension, it'll be constructive tension, but as long as it's done in a professional manner, that is manageable. So those are really, I think, the dimensions that we need to bring to bear. This is not just about economists or finance specialists. This is about psychologists and behavior specialists. Get to the nub of conduct. Why is it that we ended up with the NPLs at that level? Let's do a taxonomy. I would love to see some research on the various ways in which the NPLs were added. I was with, one of the first things I had to look at when I first arrived in government was these ready-made garments factories. Many of the employers had fled because of the links with the previous government, and the workers were on the street with unpaid wages. So we had to find the money. And once you find the money, in some cases it's government money that went in, but in other cases we had to see if the companies themselves had money that could be tapped onto or not. So we convened various banks on several occasions that were the major creditors to some of these names. And I remember the governor and I were sitting at, and those of you who've been to that meeting room in Bangladesh Bank, they have the world's longest table. If you sit in one corner, you can't see the end of it. And so everyone was there, they're from all the various banks, and you had the state-owned banks, the major creditors. And I said, so do we have a sense of what is the total amount of claims on that particular company? Sir, এটা 22 কোটি থেকে 26 কোটির মাঝামাঝি কোনো একটা অ্যামাউন্ট। মানে 4,000 কোটি, না 22,000 কোটি থেকে 26,000 কোটির মধ্যে মাঝামাঝি কোনো একটা অ্যামাউন্ট। এই মাঝখানে 4,000 কোটি is the rounding error that we have in between. Do we have collateral? Well, obviously not. Okay, who did we lend it to? Half the entities are not registered as companies. So we don't know what entity is it that we have lent money to. We have to have a Truth and Reconciliation Commission for economic crime. And NPL and how NPLs were created, I think we have to create a taxonomy, because that is the only way we can avoid repeating the mistakes of the past. They're not going to be macro, prudential regulations, policies, and laws. It's the conduct and the behavior of the micro level. Imagine a hypothetical. Right now, we have a very large fraudulent defaulter who was very close to the previous regime. They have probably a few thousand crore taka of non-performing loans. And the bank, the creditor bank, private sector bank, they have had a change in the board of directors. The new chairman, hypothetically, could be linked to the incoming government. And that chairman has an incentive, because now he or she is the creditor of that person, to rehabilitate that person in order to have any chance of recovering some of the money. Why would you not do that? If I become chairman of one of the private sector banks tomorrow, and I see that I have a criminal with associations with the previous regime, but they owe me a few thousand crore taka. If I can rehabilitate that person, maybe they will pay me half of that. My balance sheet will be protected. Why would I go down the path of criminal action? I don't know how you deal with that incentive issue, but that is where we need more research. That is where we need to make sure that we have circuit breakers in place. So let me just end with my last point, which is that if we're talking about conduct, we have to talk about conduct of everyone, including the regulator, including officials within the regulator. There should be no problem criticizing regulators. There's no such thing as a contempt of court if you criticize regulators. If that has been the case, that should not be the case. What needs to happen for conduct to improve in the public sector, but also in the private sector, is that professional bodies need to also take on some of the responsibilities. I was on the board of CFA Singapore. Are you familiar with the CFA designation, the Chartered Financial Analyst? I was also on the Global Management Committee for a brief period. They used to have, they still do, they have the mantra of ethics, education, and excellence, the 3 E's, as what defines professionalism. We have to all ask ourselves, what is the definition of professionalism in what we do? And for them, the definition was ethics, education, and excellence. And then they preside over the global financial crisis. And it turns out none of the 3 seem to have prevailed. So they went through a dramatic, in-depth, soul-searching process, as did ACRA, the accounting professionals. I think every professional, maybe bankers, company secretaries, accountants, asset managers, we all need to have our own code of conduct. And when that conduct is broken, we need to call each other out so that they do not contaminate. Oh, ready-made garments. They need to have their own code of conduct as well. So that when there is bad behavior from amongst the ranks of professionals, we call them out, and that we don't let them contaminate the good name of the profession entirety. So let me leave it here. I want to again thank everyone for the extremely valuable feedback from around the table, and of course for the address that we started. Thank you very much.
Thank you, Dr. Siddiqui, our advisor for international affairs, for a fantastic set of advice, coming up from within the banking sector. I didn't want to stop you because, but I felt like we all need to hear you out before we could, conclude this meeting. So thank you so much for sharing your very deep insights. I think people sitting around the table here have learned, have taken lessons from what you've said. So, I'm an economist, more specialized in the trade policy area. So when it comes to banking, I ask myself, look, I spent 50 years learning economics, but I'm still a novice when it comes to these banking sector issues. So I'm still learning. Every day I learn something new from the people around on what they're talking about, what's going on here. But you really point out this fantastic. It's all about governance. It's about psychology. I think we have to do the research to figure out how do these NPLs reach this level, 35% of all loans. It hasn't happened in history or in those other countries which faced the crisis, global financial crisis and the East Asian financial crisis. It was not 35%. So there's a lot to learn from those events, but Bangladesh, I think, gives us a very, very unique situation. And when I talk of trade, I also find Bangladesh to have a very unique set of, trade policy issues. It's so different from any other country. So Bangladesh probably needs, its own resolutions of the banking sector. The way in those cases, we used to hear the talk about too big to fail, and yet they let Lehman Brothers fold. In the context of Bangladesh, I think we are saying these are too toxic to fail. These banks are too toxic. So you can't just let them fail because the toxicity is going to spread around the economy. So you can't let it happen. So I guess that's the lesson. And all the experts around, I think, have told us what's going on. They understand what's really the bottom line here. So thank you very much. I thank all of the participants here for sharing their insights, their views, and I think we go out of this room with a much more better understanding of the crisis that we are facing. But the good thing is the economy is still running. It's muted growth. We didn't face a negative growth situation, which Korea, Thailand, and those other countries in the East Asian economies they face. So we have muted growth, but hopefully the way the banking sector, at least the hemorrhage has stopped, and the banking sector is, seeing some life again. I'm hoping that the projections about growth of about 5% for the next year is likely to take place. I'm assuming that we have a nice and fair election in February 2026. That would be a great gift to this nation by the interim government, I think. And we all look forward to an elected government which also manages economic policy the way we expect it to. Thank you very much for the understanding of it.
Yes,